Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. I'm joined today here in San Diego by Cullen Roche, who is the founder and chief investment officer at Discipline Funds, which is a low-fee financial advisory firm with a focus on helping people be more disciplined with their finances. He is also the author of Pragmatic Capitalism, which I read while I had COVID, and it was wonderful. And my favorite hat that Cullen wears is that of a financial mythbuster, and we are going to have him wear that hat today. Welcome.
Hey, Daniel. It's great to be here.
Yes, sir. Thanks for Bob Seawright for letting us use the kitchen table to record this. Miss you, Bob. Love you. Okay, so you sent me a paper yesterday that was called All Duration Investing. And it's a new framework you're kind of launching that you posit has behavioral upside for investors. Tell us a little bit about it.
Yeah, so haven't published it yet, so I'm still getting feedback from smart people like Daniel. But to me, investing it's inherently psychological. So, it's really a battle with ourselves in so many ways. And I think that one of the interesting things that I've sort of discovered is that it's not just a battle with our own emotions. It's really a battle to understand time. And it's one of the most challenging aspects of investing, is just trying to navigate the different time horizons that we're grappling with, because we've got all of these short-term liabilities that we need to meet across time, things like your monthly mortgage payment, or your college tuition payments going out further and further, and your retirement planning. And these are all temporal problems, but these are liabilities that we all want to achieve some degree of certainty around in the long run. And I think that one of the useful frameworks that I've come across is trying to match certain assets with certain liabilities. So for instance, everybody probably holds on to some cash in their bank account just to be able to meet like their weekly or monthly liabilities, whatever that might be. And cash works as a perfect short-term nominal protective instrument, because you know that $1 is going to be $1 in a month. And the further and further out you go across all of these different time horizons, the more and more challenging this gets, especially because a lot of different instruments, they don't have actual time horizons. So you can look at things like, say, a 2-year treasury bond, or a 5-year bond, or a 30-year bond, and those things have specific structural time horizons around them. But where things get really tricky is with things like the stock market. The stock market doesn't really have a time horizon applied to it. And so what I've done with this paper, which I think is really, the goal is to create some behavioral certainty around time horizons, is I've basically created a model where I calculated the durations for certain asset classes, for all asset classes. So you can actually plug in any strategy to the model and it'll spit out a duration. And so for instance, using this model, I basically come to the conclusion that the duration of the stock market is about 17 years. And the goal of that is to help somebody put the stock market in the proper temporal perspective, where they can look at the stock market and say, okay, the stock market hasn't done well over the last 17 days or the last 17 months, but I know that component, that allocation of my portfolio, it's not designed for that time horizon. It's designed for a longer time horizon. Maybe it doesn't have to be 17 years,
right?
But it's an inherently longer term time horizon type of instrument that gets you away from this, really the behavioral bias of short-termism, where people are struggling to understand what's happening in the short term because they really don't have certainty around the time horizons of their financial assets.
Yeah, so you even said in your email to me that it's a bit like goals-based investing, where you sort of bucket different strategies by their level of volatility, and that has behavioral upside that I've written a lot about and talked a lot about on this show. You're basically saying, let's align a 95% probability of a positive return type situation with a temporal timeline, and then say, I'll match those assets and liabilities using that temporal framework.
Yeah, exactly. So you can take, using like a really simple example, let's say that you've got somebody who they've got, say, a certain amount of monthly liabilities for like credit card payments or like mortgage payments. And then let's say that they have another bucket that they want to set aside for, say, a down payment for a house that they're planning on over the course of the next like 3 to 5 years. And then they've got like retirement planning, or like maybe they're looking at like their college tuition payments for their children or something like that. Those are the longer term buckets. And you can take these three things, these three very specific buckets, and you can apply specific time horizons where you're saying, okay, I'm going to hold cash and treasury bills for the super short term bucket, and then what fits into that medium term bucket is sort of like things like a bond aggregate or like a 5-year treasury bond, something like that. And then the stock market fits into like your long term. But the cool thing with this approach is that you don't have to use, it's not like a traditional bucketing strategy where you're kind of fitting like 3 buckets. You can actually do this across all time horizons. So I called it all duration investing because you can take this with almost every single asset class and you can structure it out across 10 time horizons. You could structure it out across 100 time horizons where you're kind of covering all of these different time horizons, all of these different probable outcomes with actual assets and time horizons that they put things in the proper temporal perspective from a behavioral perspective where you can look at this and say, okay, my 60-40 portfolio isn't doing great this year, but the interesting thing with the 60-40 is that when you blend those two allocations into one index fund, for instance, you crunch down the duration because you're blending the stocks with the bonds. Yeah. And so what that does, and this is one of the basic benefits of diversification, is that you reduce your duration by creating greater certainty across certain time horizons. And so a 60-40 has like an 8-year duration in my model, where compared to the stock market, if you were just holding 100% stocks, you're 17 years. And you can fit that 8-year bucket then into a time horizon that is much more behaviorally tolerable.
Yeah, I love the idea. The paper's great, and the chart you talked about where you give a duration to many of the major asset classes is worth the price of admission for the paper. What about the fact that...
The paper costs $0, by the way.
That's true. The paper is free. Yeah, that was a joke. What about the tendency, though, of all time frames to become today under behavioral pressure, right? I mean, we know that there's plenty of sort of quote-unquote long-term investors who become very short-term investors under sufficient pressure. How does this model sort of account for that behavioral tendency?
Well, I think the nice thing about this is that when you go through, especially environments like today, for instance, where the stock and bond markets both look pretty horrible for the first 6 months of the year, using a framework like this, you would have a tendency, and these periods are always hard. I mean, there's no getting around that. Yeah. Like anytime the markets are doing what they're doing now, or 2008 or March 2020, all this uncertainty, the world looks like it's, like it might really be different this time, because that's always the mentality that people have. It's one of the things I laugh about with like risk profile questionnaires is it's like you send this thing out to somebody and there's always this question like, what do you do when the market's down 30%? And everybody says, oh, I buy more, I sit tight. Yeah. But in the throes of it, everybody feels like, no, it's different this time. Yeah. The market's down 30, it's going to go down another 30. So now I need to react differently. But the kicker with this sort of an approach is that you've set aside funds across specific time horizons where, you may not have a lot of certainty in the last 6 months, or even if these asset classes continue to do what they've been doing for the next 6, or let's say 6 months, let's say they do this for the next 6 years, behaviorally you've put aside funds across specific time horizons where it shouldn't be as behaviorally challenging to navigate, because you've got, for instance, a lot of cash in this sort of an environment, because you need to fill those shorter term time horizons where maybe you hold a more significant chunk of like 2-year treasury notes, things like that, where you're holding these things that apply to certain time horizons that they give you a little more comfort, because even though they're not sexy instruments, they're not the high return type of instruments that Bitcoin has been in the last 15 years, or the stock market has been. They provide you with this behavioral hedge, basically, where you're across these really uncertain short period time horizons. You have a lot more certainty in your portfolio because the nominal stability of those instruments is there.
Yeah, well, in the paper you say no one ever got broke, no one ever gets impatient with sort of a certificate of deposit.
Yeah.
And I think as we can align investors' gaze with their goals, right, and manage those expectations, I think you're going to see much better behavioral outcomes. So I want to switch it up and move to the book now. You really came onto my radar as that rare, sensible voice when it comes to thinking and talking about the Fed. And like, for whatever reason, there is just so much bias and misinformation and just so many shenanigans around this. And I'd like to take some of the specific points from Pragmatic Capitalism and talk about them, because I hear these repeated quite frequently, and I feel like I even misunderstand some of them. So let's go to the lightning round on central banking. So myth number one: China owns the USA. I hear this repeated quite often. Take this one on.
Yeah, so this is the idea that because the Chinese government owns a lot of treasury bonds, that they therefore own so much of our assets that they by virtue of this, they end up basically owning, they have like a kind of a death grip on the U.S. government's ability to control, its policy going forward. And, this is tricky because you get into foreign trade, which is, I don't want to like put everybody to sleep, but the basic way to think about this is that there's a trade-off here. There's an inherent trade-off in international trade, and that's part of the big purpose, or the big reason why we're even involved in China to the degree that we are, is because what generally happens is you have big corporations that are outsourcing, say, employment or, costs of building goods in factories or whatever. And so Apple, builds a factory in China. They move a whole bunch of workers over there. And what's happening is that China's benefiting because the majority of the workers over there are going to be Chinese, domestic, population workers who are earning a higher income than they probably otherwise would. So they're getting all of this investment through not just the ability to utilize the technologies that Apple is building over there in their own framework, in their own economy, but they're building the skills that are, kind of multiplying off of having, this very innovative company there. So China's getting this benefit of having domestic investment there, real or foreign domestic investment coming into the country. And the United States is getting lower prices. And what's happening there at a really basic economic level is that the government is essentially, we're sending money there. And the way to think about this is the dollars go to China. Mm-hmm. Okay. Now, what does China do with the dollars? Well, the Chinese central bank ends up eventually getting these dollars, because eventually what happens is basically the domestic entities through foreign exchange, they'll convert their U.S. dollars to renminbi or whatever. So the central bank there, the government in China, ends up having these dollars because of this trade-off. And what do? They end up buying treasury bonds or other U.S. government assets. But the important point is that China, it's not like China funded the U.S. government's spending. We sent them dollars out of our own volition, basically, because we wanted to make cheap stuff there, basically. We didn't have to send it to China. We could have sent it to, frankly, we could have kept it here. We could have sent it to Mexico. We could have sent it wherever we wanted to, really, wherever that corporation wanted to be based. So there's no, a lot of this is about I think the first principles of understanding what foreign trade really is. It's not that the Chinese government bought the treasury bond that allowed the treasury bond to even be created. It's that really the money flowed to China, and then the Chinese government didn't have anything to do with it other than, say, buy a treasury bond or go, you could go do what Japan did back in the late 90s and buy up half of California or whatever, right before real estate prices crash and stuff. And, but getting I think the order of operations there is super important, because, it's not that China funded the U.S. government spending. It's really actually backwards. It's that China just ended up with this money and then they didn't really have anything to do with it.
Yeah. Myth number 2, QE is just printing money.
So this is the same sort of thing where what happens with quantitative easing is that really the only reason that quantitative easing even happens is because the central bank ends up converting a certain amount of treasury bonds into what's basically cash or deposit reserve balances. And so again, this is getting the order of operations correct. What happens in the first instance is that the Treasury, the U.S. government, expands its balance sheet, creates a treasury bond to fund some spending, and then that bond goes out into circulation. And then after the fact, the central bank comes in when they do QE, and they exchange the treasury bond for the cash. Mm-hmm. So what they're doing, to think of this in terms of the order of operations, the Treasury is the entity that actually expanded the amount of financial assets in the economy. The central bank just came in after the fact, and all they do is they buy the Treasury bond, they take the Treasury bond out of domestic circulation in essence, and they swap it with cash. Mm-hmm. So all that's happened is the real, if you want to call it money printing, the real money printing or the real asset price or the real asset inflation occurred through the Treasury's deficit spending, the creation of the bond. The central bank, all they did was they just exchanged, a bond for cash. Mm-hmm. So they changed the composition of the private sector's assets. They didn't necessarily increase the quantity. So it's all about getting the order of operations right. And this is, the last couple of years has been really interesting because it's one of the things that I've kind of harped on over the course of the last 15 years because in 2008, we ran huge QE programs, mm-hmm. and a lot of people thought it would cause hyperinflation or high inflation, and it didn't. And the reason and the difference between 2008 and today is that during COVID, the government ran huge deficits. So we created a huge amount of treasury bonds, and then we did QE on top of that. But the big difference is that in 2008, we ran minuscule deficits. There was not a lot of treasury bond creation basically back then. And so the big difference between 2008 and COVID is essentially that the lesson is that fiscal policy, government spending, and the government creation of the treasury bonds, that's where the real, if you want to call it money printing, that's where the real money printing and the real inflation risk comes from. It's not from quantitative easing.
So take it to today as we sit here with very high inflation. Do you believe that the government's actions are partially to blame for where we sit today at 8.5-9% inflation?
Oh yeah, I would say absolutely. I mean, a lot of people want to say that COVID was just a supply issue, and there was actually a great paper that came out like a month ago from the San Francisco Fed that broke this all down, and their basic analysis was that it was something like 40% caused by government spending, and the other 60% is sort of either unknown or supply constraints. It's been certainly, I think it's been a lot of both. I mean, we shut down the economy for, however long, so there were natural supply constraints. And then, but really the big bazooka was that the government essentially printed, $7+ trillion of money within a 2-year period.
Right.
So huge amounts of deficit spending. And it's a tough debate because the counterfactual is that we probably would have had this huge catastrophic depression type of environment. So it's easy, it's obviously easy to look back in retrospect and say like, oh, we did too much. But in the throes of it, like I remember March 2020, April 2020, man, that was pretty friggin' scary.
Oh yeah.
And I remember thinking, like, God, if we don't have a huge policy response, like, this is going to be really, really, really bad. It ended up, I think, in retrospect, I think all of this has ended up, at least from a health perspective, it's still been really bad, but it wasn't, like, Spanish flu-like. Mm-hmm. So it wasn't as catastrophic, I think, as maybe a lot of people feared. So it's easy, I think, to look back and say, like, oh, we did too much. But that's just hindsight's always 20/20, right?
Yeah, that counterfactual idea is a good one to keep top of mind because yes, gas is expensive now, everything's expensive now, but what's the counterfactual?
Yeah.
We had a 35% dip. It could have been much, much worse. I was spending some long nights looking at financial history at that time and thinking, without a big response, we're going to be down, 60, 70%.
I had a 1-month-old at the time, so I was basically crying myself to sleep every night.
What a time. What a time to bring new life into the world. So the last one we'll take on is that we're on the cusp of losing reserve currency status. This is one I hear put forth a lot. You don't think that's the case?
I mean, every global superpower eventually loses reserve currency status. But I think the thing that I think some people get wrong about this is that there seems to be this myth that reserve currency status is something that's like bestowed upon a country, as if like, almost like somebody being knighted or something. Like it's not, you don't just get, deemed the world reserve currency. You have to earn it over a really long period of time. And what happened, for instance, when the British Empire was the reserve currency, the British pound, they earned that. They had conquered basically like the entire world.
Right.
So like foreigners and foreign countries owned a lot of British pounds because they were just such a dominant superpower. And the same basic function has occurred in the United States over the course of the last 100 or so years, where the U.S. economy has just been so enormous, has grown so fast, has been so productive that by virtue of kind of like what we were talking about before, foreign countries end up owning a lot of U.S. dollars. Mm-hmm. And that's just, you want to do business with the biggest consumers in the world, you've got to use the U.S. dollar. Mm-hmm. And so a lot of foreign countries end up owning dollars and dollar reserves because they get them through foreign trade, in essence, because they're just doing business with the biggest consumers in the world.
Yeah.
So again, it's one of these things where, will the U.S. economy shrink in the long run and likely become less productive? Yeah, I would argue it's almost certain. I mean, especially with the growth of China and globalization and India and all these big emerging market economies, the relative size of the U.S. economy is almost certain to shrink. But does it mean that there's going to be this resulting collapse in the dollar currency and the dollar or the U.S. economy? I doubt it. I mean, I guess anything can happen. We all kind of know that after the course of the last few years, so right. I shouldn't make, extreme predictions. But my guess is it'll be something much more gradual, where China and India grow and become much larger in a relative sense, much more important in the global trade scheme of things. And they just slowly sort of overtake the U.S. dollar because of just natural size, growth.
Yeah, no, it makes sense. So we're going to set that aside for a minute. Another thing that I loved about your book was just, again, sort of taking on some of these sacred cows. One especially cherished notion that you take on is that buy and hold is best. You provide some nuance there. You're not against buying and holding, but you do provide some nuance around this sort of simple gospel nugget that I think so many people hang on to. Why do you think there's some nuance there?
Well, this is one of those debates that, it's like the active versus passive debate in financial circles, where there's a huge amount of gray area there. And I think sometimes our industry tries to break these things down largely for marketing purposes, because when you make something binary, it's just easier to sell to people, in essence. And the reality is that, kind of going back to the temporal discussion that we were having earlier, managing your finances is messy. And it involves a lot of activity. It involves a lot of different time horizons and navigating all these uncertainties. And the time horizons aren't just all different, but your time horizons are always changing because life is so uncertain and changing. Right. And you have to sort of evolve and navigate all of that. And a lot of that involves a certain degree of activity. And so the idea of active investing always kind of gets a bad, I think, name. And the reality is that, one of the things I've done a lot of work on is understanding really looking at especially the financial markets from an operational perspective. You realize that the financial markets change so much.
Yeah.
And it's funny if you've ever been or you ever like see a picture of like the Vanguard trading desk. This is the firm that's known as like the most passive indexing, post passive investing type of firm in the world. Their trading desk is a monstrosity of computers and traders sitting there changing the indexes all day, every day.
Right.
And so, one of the lessons when you start to really get it, dig into the guts of all this and how it really works is that there is no such thing as true passive.
Yeah.
You can't be completely passive. And in fact, it would be counterproductive to try to be completely passive. And so, I think that buy and hold is great, and I'm a big advocate of things like managing your taxes and low fees. I'm a huge advocate of low fees and controlling, especially the cost that you can control. But you don't want to be passive to the point where it's like counterproductive. And I think that from a buy and hold perspective, you could look at something like that and you could say, oh, stocks for the long run is the best approach. And then if you're someone who is, say, 45 years old and you've got 2 kids and all these different, sort of confusing and difficult to navigate time horizons, you could read something really simplistic like that and say, well, I'm not retiring for 30 or 40 years. I'm just going to buy 100% stocks, let it ride, and that's my stocks for the long run. That's my buy and hold type of approach that in the long run will work out great. But again, like I said, the stock market is a 17-year instrument. And so can you navigate 17-month or 17-day periods where that thing is down 10, 20, 30%? And has that framework created a counterproductive mentality for you where it's going to create behavioral biases where you basically are forced at some point to abandon your plan because you realize that you don't actually have the assets to match your temporal liabilities across time?
Yeah, I feel like a lot of times folks confuse averages with reality, right? Like I even saw this a lot in among early retirees who do a lot right. They take appropriate risk, they manage their fees, they're patient investors, but they're like, well, I'll get 7 to 10% a year. Like, well, yeah, on average, right? Yeah, on average, and on any given year, you might be down 50%. Mm-hmm. So, like, life's a little more complicated than that. I think you introduce some appropriate nuance there. The next 2 sort of sacred cows you question, I think, are really hard to take on right now because they've done so well recently. There's a strong element of recency bias. You take on the ideas that commodities are a good investment and that your house is a good investment. Mm-hmm. Sir, my house is up 100% in the last 5 years. No, take this on because you're right. When you look at the history, right? Schiller looked at the history of housing in the U.S. It about keeps up with inflation, right? But it's hard to tell people that. And it does feel like this time is different. How should we think about our homes and commodities?
Well, I think it's, again, you kind of have to be nuanced about this stuff because when you're comparing especially things like real assets like a house to, say, the stock market, you can buy the whole U.S. stock market today for virtually no cost, no expense ratio. And it can be implemented in a super tax efficient manner. When you buy a house, it's funny when people think about the returns on their home, they tend to only think about the price they paid and the price they sell.
Right.
And they forget about, the air conditioner broke 10 times along the way, right. Or the pool flooded, or we have termite damage, things like this that occur. That a house is a really, really expensive financial asset to own. I should say it's a non-financial asset technically, but it's a really expensive asset to own. And so I think that you have to put this in terms of your total return. And that's the thing that I think is important to understand in this context is that, Thornburg, I think, was the company that I cited in the book, that they cited their total returns on the total returns on housing. And that's taking your after-tax, after-fee return in real terms. And when you back out all of the taxes, all of the costs of that go into a house, and then you back out inflation, what you find is that housing it generates, 1, 2, 3% a year, something like that. Depending on, obviously, if you time it right, like if you bought a house right before COVID or whatever, you've done really well.
Yeah.
If you ticked the bottom of the market in 2012, you've done really well. But on average, when you look at it from a financial perspective and what the total costs are, housing is really expensive. And so I prefer not to get people out of the mentality of thinking of their house as something that they're going to make money on. The house is something that really, it provides you with shelter. It provides you with a roof over your head, some place of comfort that you can, raise your kids in. It's not, I don't like thinking of it as a place where people are trying to necessarily make money or get rich quick, which I think is a lot of the mentality that the house flipping shows kind of sell and stuff like that in the last 10 years especially.
Yeah. So with this final question, I've had fun because when I was reading your book, I just love it when people take on these sort of cherished one-liners that really are more about marketing than nuance or helping people. So I loved that about your book. But I don't want people to get the idea that you're just sort of out a fun hater, or that you're just a deconstructionist, right? So you also run money, you advise clients. We've talked about a lot of your ideas today. What practically does that look like when you're running money, when you're helping clients in light of everything that you've discussed today?
I mean, it starts with, I think, building a really customized and personalized financial plan. I think that one of the reasons why so many of these slogans, I think, get so much momentum is because the asset management side of our business is so involved in selling stuff, and they sell narratives, and a lot of these narratives are very intriguing and eye-catching, and it's easy to get caught up in buying into that. And a lot of these narratives are, to be frank, a lot of them are counterproductive to what the average person should really be doing. And they should be building a financial planning based foundation that's consistent with whatever their personalized goals are. They shouldn't be, really probably shouldn't be using their portfolio to try to get rich quick or, make mad money or fast money or whatever the, TV shows are selling us all. And they should be starting from a financial planning based foundation and building these concepts out across really practical time horizons that are matched with their financial goals, and implementing a lot of the things that we all know are true, which is, control your costs, control your taxes, diversify. I hate the mentality of using a portfolio as really a get rich quick bucket. And I go to extremes in the book of really talking about how our portfolios are literal savings portfolios, getting away from even calling this investing, because investing is this sort of, it has this, kind of sexy connotation to it, whereas saving is very boring and long run. But I like focusing on that because from a really strict operational perspective, that's what you're doing when you buy stocks and bonds. You're taking in income, you're saving it, and then you're just allocating it to these assets across certain time horizons to help you meet certain financial goals across time. And that whole process of saving versus investing it's very different in the sense that you're really trying to be much more prudent and practical with your savings than the concept of investing, where I think people oftentimes confuse it with something that's more like gambling, to be honest.
Now, I've never heard it framed that way, but I actually really like it, right? I think that is the thing. We think, well, this is an investment, so it should always be going up. It should always be compounding. It should always be growing. That's not the way it works.
Yeah.
Unless you're looking at these time horizons, the 18
Well, I come from this nerdy econ background, and so when I'm defining these terms for the book, for instance, investment has a very specific economic definition. Right. It means to spend for future production. And when you buy stocks and bonds, that's inherently not what you're doing. And so, when an entrepreneur invents something and is creating something that's new, they spend money on certain things, whether it's a factory or widgets or whatever it is, to create future production. And that generally is a very high-risk endeavor. Whereas when somebody buys stocks and bonds, all they're doing is they're earning an income, and then they're allocating it to an instrument that actually financed a firm's past investment. And so, I kind of got into this situation where I was like, why do we call this investing when it's literally not investing in the proper economic sense. And I know we're getting kind of bogged down in like jargon and terminology, but to me, it drives me crazy because so much of the industry is involved in selling jargon to people that just doesn't actually make, realistic sense in any meaningful, practical way, and is instead utilized to sort of sell these concepts or products to people that are in a lot of ways end up being counterproductive.
Well, from the psychological perspective, this is sort of Psych 101. This is cognitive behavioral therapy 101. Yeah. The words we use matter. The words we use and the way that we frame things, whether it's our own thoughts or intentions, impacts our behavior. And so it can get a little wonky, but I think it's a conversation worth having. And I'm glad you're out there. Your book was like $5,000 a piece. It's like you and Seth Klarman. Your books are going for $10,000 a piece. But you're self-publishing it now?
I self-published it. I had a 6-month battle with my publisher because they wanted to keep the Kindle rights and give me the hard copy rights because they didn't want to keep publishing the hard. It's like 8 years old or something.
Right.
It sells okay, but not like people aren't like bat fighting each other tooth and nail to learn what the difference between saving and investing is. So, I got the rights back. So now I self-published it and went through, and it's a fun process because the publisher sends you a PDF that you convert to Word, and then the whole document blows up in your face. And
so you got your master's back. You're back in charge. It's not going to be $5,000 anymore. So if people want the book is called Pragmatic Capitalism. If people want to learn more about you, your writing, the new paper, the fund, where can we find you?
So most of my writing's at Pragmatic Capitalism. The company is Discipline Funds. But really most of everything drives through Pragmatic Capitalism, which is the blog that I write.
Awesome. Hey, thank you for coming out. It's been awesome to hang with you, and we're going to hit a beach here soon. And thanks for trying to get me to move to Southern California and for dropping some knowledge today.
Yeah, thanks for having me.
All right.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.